Think estate planning is just for the ultra-wealthy? Think again. A lot of people assume that if their estate is under the 13.99 million federal estate tax exemption, they are off the hook. No estate tax, no problem. But that's a big mistake. Even if you don't owe federal estate taxes, you could still be losing thousands or even millions to capital gains taxes, state estate taxes, and other hidden fees that drain what you leave behind. And here's the real shocker. Some common estate planning strategies could actually cost you more in the long run. So today, I'm breaking down how to protect your wealth, avoid costly tax mistakes, and make sure more of your money stays with your family, not the IRS. Most people think of gifting as just giving away money. But when done right, it's actually a powerful tax strategy that can help you and your family keep more of your wealth instead of handing it over to the IRS. The key, knowing what to gift, when to gift, and how to do it tax efficiently. Picture this. You bought shares of a blue chip stock decades ago for $250,000, and today they are worth $1.5 million. If you sell them yourself, you would owe capital gains tax on $1.25 million of profit, which could mean $250,000 or more in taxes, depending on your tax bracket and state. But what if you gifted those shares to your retired mother instead? Since her taxable income is lower, she'd likely owe much less in capital gains tax than you would. Instead of paying the highest tax rate, she could sell the stock at a lower bracket and keep more of the profits. Same stock, same wealth, but now you've shifted the tax burden in a way that reduces your overall tax bill for your family. Most people think that anytime you sell an investment, you will owe capital gains tax. But did you know that if your taxable income is low enough, you could sell investments and pay zero capital gains tax? It's a strategy that many people overlook, but one that can save you thousands. Here's how it works. In 2025, a married couple with taxable income under $96,700 can sell investments and pay zero capital gains tax. That means they could sell appreciated stock, keep every dollar, and reinvest tax-free without losing a cent to taxes. And here's the best part. If your income fluctuates from year to year, you might have windows where you can harvest capital gains tax-free. It's a simple but powerful strategy that most people never take advantage of. Here's a tax mistake that catches way too many families off guard. Gifting assets that would have been better left alone. People assume that handing off property or stocks during their lifetime is a smart move, but sometimes it's the exact opposite. Here's a common situation. You've been holding onto a stock portfolio for decades, and it's grown significantly in value. You bought shares of a company for $50,000 decades ago, and now they are worth $500,000. You think, I'll give this to my kids now so they can benefit. Sounds generous, right? But here's the problem. When they sell, they will be taxed on the full gain, meaning they could owe capital gains tax on $450,000. Now, consider another approach. You hold on to those shares and pass them down when you are gone. The moment they inherit them, their cost basis resets to the market value on that day. If they sell right away, they pay zero capital gains tax. That's a massive tax savings just for doing, well, nothing. The same goes for real estate. Maybe you bought your home years ago for $200,000 and now it's worth $1 million. If you gift it now, your heirs inherit your original cost basis. So when they sell, they will owe tax on $800,000 of gains. But if they inherit instead, boom, the basis resets to $1 million. This is why knowing when to hold and when to transfer is critical. Gifting cash or assets that won't appreciate, no problem. But highly appreciated assets, let them inherit. It's one of the easiest tax breaks available, and most people miss it. That is exactly what we do when working with clients, helping them reduce taxes, protect wealth, and make smarter estate planning decisions. If you want peace of mind knowing everything is in place, let's talk. Click below to schedule a meeting or give us a call, and let's create a plan that gives you confidence in your future. A lot of people assume trusts are only for the ultra-wealthy, but the truth is, even a modest estate can benefit from a well-structured trust. Whether you want to avoid probate, protect assets from creditors, or ensure your wealth is distributed on your terms, a trust can be one of the most powerful estate planning tools available. Let's say you have $2 million in assets, including a home, investments, and a vacation property. If everything is in your name, your estate will go through probate when you pass. That could mean months or even years before your heirs receive anything. Instead, by placing assets in a revocable living trust, you avoid probate completely, allowing assets to transfer smoothly to your heirs, remain in full control during your lifetime, with the ability to update or revoke the trust at any time. Ensure your assets are managed properly if you become incapacitated. A revocable living trust doesn't just make estate planning easier, it simplifies wealth transfer and keeps your family out of court. Next, imagine you've built up significant savings and investments, but you are worried about lawsuits, creditors, or future long-term care costs. An irrevocable trust helps shield your wealth from potential financial threats by legally separating assets from your estate. Assets inside an irrevocable trust generally can be touched by creditors or lawsuits. If structured properly, it can also help with Medicaid planning, allowing you to qualify for benefits while preserving assets for your heirs. Unlike a revocable living trust, you give up control, but in exchange, your assets are better protected. If asset protection and long-term care concerns are on your mind, this kind of trust can keep more of your wealth intact for your loved ones. Now, if your goal is to leave a lasting financial legacy for your children and grandchildren, a dynasty trust could be the key. A dynasty trust allows you to keep assets protected from divorce, lawsuits, and financial mismanagement. Control how and when money is distributed, ensuring heirs do not overspend. Potentially reduce estate taxes for future generations, depending on state laws. Even if your estate isn't taxable today, a dynasty trust ensures that family wealth continues to grow tax efficiently for decades. Since we are already talking about trusts, let's address something that often gets overlooked: outdated trust structures that might actually be creating tax problems instead of solving them. If your estate plan was originally designed to minimize estate taxes, but you are now well under the federal exemption, your existing trust setup might actually be costing your heirs in income taxes. Bypass trusts and irrevocable trusts, for example, were once essential for avoiding estate taxes. But today, for non-taxable estates, they might create an income tax problem by preventing assets from getting a step-up in basis at the surviving spouse's death. For example, John and Linda set up a bypass trust in the early 2000s when estate tax limits were much lower. When John passed away, his half of the assets went into the bypass trust, which means they no longer qualify for a step-up in basis when Linda later passes. Now, when their children inherit the assets, they owe capital gains tax on the growth of the trust assets, instead of getting a tax-free step-up. If you have an older trust in place, it's worth re-evaluating whether it still serves your needs, or if adjusting your structure could save your heirs from unnecessary taxes. If you are planning to pass down a large IRA or 401k to your heirs, the Secure Act changed the game. In most cases, non-spouse beneficiaries must now withdraw the entire balance within 10 years, meaning a $1 million inherited IRA could turn into a major tax headache if your heirs are in their peak earning years. Let's take Lisa, for example. She is 50 years old when she inherits a $1 million IRA from her father. Sounds great, right? But there is a problem. Lisa already earns $175,000 per year in salary. Under the new rules, she must withdraw the full IRA within 10 years, which means she will be adding an extra $100,000 per year to her taxable income if she spreads it out evenly. That extra income will push her from the 24% tax bracket into the 35% bracket, meaning she will pay hundreds of thousands more in taxes than she expected. So instead of keeping more of the inheritance, Lisa is handing a huge chunk of it to the IRS. How do you avoid this problem? One solution is a Roth conversion, a strategy that allows you to move money from a traditional IRA to a Roth IRA and pay taxes now at today's rates, so your money grows tax-free forever. Consider if instead of leaving Lisa a $1 million taxable IRA, her father had converted portions of it into a Roth IRA over several years. Now, instead of being forced to withdraw taxable income over 10 years, Lisa inherits tax-free money that continues to grow tax-free. No RMDs for Roth IRAs. More tax-free growth. Heirs do not owe taxes on withdrawals. Lower total taxes over your lifetime. Even if you don't need the money, a strategic Roth conversions can reduce taxes for both you and your heirs, ensuring they inherit more and pay less to the IRS. Another strategy you can consider is a split IRA strategy. Instead of leaving the entire IRA to the surviving spouse, you split the IRA at the first spouse's death, leaving half to the spouse and half to the children. The children will get 10 years to withdraw their portion of the IRA after the first spouse passes, while the surviving spouse could keep their half and continue tax-deferred growth. Then, after the second spouse passes, the remaining IRA is inherited by the children, giving them a second 10-year period to withdraw those funds. Instead of forcing heirs to withdraw everything in one high-tax 10-year window, this strategy spreads the tax impact over multiple decades, reducing the overall tax burden on the family. Another way to soften the tax impact of an inherited IRA is life insurance. Think about it. Instead of leaving behind a $1 million IRA, which your heirs will be forced to drain and pay taxes on within 10 years, what if you strategically used withdrawals during your lifetime to fund a life insurance policy instead? Here's why that works. Life insurance pays out tax-free. No income tax, no surprises, no required minimum distributions, no forced withdrawals. Your heirs can use the payout to cover the taxes on any IRA distributions they do receive. For families with large IRAs, life insurance can act as tax-free replacement for taxable retirement assets, ensuring heirs get the full benefit of your legacy, not just what's left after taxes. Now, tax strategies are just one part of the equation. Making sure your assets actually go to the right people is just as important. That's where beneficiary designations come in. Many people believe their will controls everything, but that's not true for retirement accounts, life insurance policies, or payable on death accounts. These assets pass directly to the named beneficiary, bypassing your will. The problem? If your beneficiary designations are outdated or incorrect, your assets could end up in the wrong hands or face unnecessary taxes. Here's the situation that happens all too often. You set up your IRA years ago and listed your ex-spouse as the beneficiary. You've since remarried and think your will updates everything, but it doesn't. Since IRA and 401k accounts follow their beneficiary forms, not your will, your ex-spouse would still inherit the money even if your will says otherwise. Review and update beneficiary designations regularly. Make sure life insurance, IRAs, and annuities go to the right people. If you want more control, consider naming a trust as the beneficiary. While federal estate taxes may not be a concern, that doesn't mean you are completely in the clear. Depending on where you live or where you own property, you could still face state-level estate or inheritance taxes. 12 states plus Washington, D.C. still have their own estate tax, and 5 states impose an inheritance tax. For example, Oregon and Massachusetts tax estate starting at just $1 million, far below the federal limit. Illinois, my state, and New York also have state estate taxes that kick in well before the federal exemption. Pennsylvania and New Jersey have inheritance taxes ranging from 4.5 to 16%, depending on who inherits the assets. If you live in one of these states, or if you own property in one, it's important to plan ahead. Smart gifting, trust strategies, or even relocating to a tax-friendly state could help minimize or eliminate state-level estate taxes. You might not have to worry about federal estate taxes, but that doesn't mean planning isn't important. The way you structure your assets can still determine how much of your wealth stays in your family. The choices you make now can shape your family's financial future. From gifting strategies to updating trusts, small adjustments can have a lasting impact on your legacy. At the end of the day, estate planning isn't just about what you leave behind. It's about making sure it goes exactly where you want, in the smartest way possible. Because let's be real, your family should benefit from what you build, not the IRS. Speaking of making sure your wealth transfers the right way, one of the biggest mistakes I see is picking the wrong trustee. Choosing the right trustee can make or break your estate plan. Get it wrong, and your heirs could face delays, family disputes, and even unnecessary taxes. But don't worry, I've got you covered. In this video, I'll walk you through exactly how to choose the right trustee, so make sure to check it out.